All right. Looks like we are live. So, welcome to another Mortgage Monday where Andrew and I get to have a chat about what's going on with mortgages as well as provide a little bit of education so people can truly understand what they're getting into. Typically, when we buy a home, it is our largest single investment, meaning it's a pretty massive check that we have to write. And so, what we're trying to do here is really have everybody be able to understand and simplify mortgages because it can be a little complex and confusing. So thanks for joining us today, Andrea. We're going to be talking about the mortgages. We're going to talk about fixed versus variable and really understanding some of the differences there. But we're also going to, at the end, we're going to go over some of the changes that the Canadian government is proposing to come up in the not too distant future. So thanks for coming in, Andrea.
Thanks, Jason. I'm excited to be here. I love meeting on these Monday mornings. It makes my Monday a little brighter. So, um, yeah,
Perfect.
let's get into it.
Yeah, always great to connect. So let's go right into, can you explain the difference between fixed mortgages and variable mortgages?
Yeah, so this one is a common question with borrowers. So fixed interest rates or fixed mortgage is where you lock in a mortgage rate, say 4.6%, and you're fixed with a lender and that mortgage rate for whatever term that you pick. So the most common ones right now are 3 or 5 years. And so you're locked in at whatever payment that is, at whatever interest rate that is for that length of time. And these fixed rates are derived from our Canadian bond yields. So if you were to take a 3-year fixed rates, we would look at the 3-year bond yields on Canadian bonds. And, generally what we look at is what the bond yields are at right now. We're sitting, they say anywhere between 1% and 2%, but generally speaking, it's usually about 1.75%. So, if you were to bring up the bond yields, you can always calculate what kind of the rates would be for 3-year, 5-year, those types of terms based on what the yields are sitting at and taking 1.75% above that. That would be the general rule. So yeah, fixed rates are kind of you're stuck in that. Not I don't want to say stuck. That seems like a harsh word, but you're fixed in with that lender at that rate for 3-year time or 5-year time. Um, if you look at
Yeah.
variable rates, sorry.
In all fairness, you use the word stuck. Sometimes it may feel that way if you're in an environment where rates are declining.
Yeah.
Now, but at the same time, it's also a real protectionist measure where if you say, no, I'm the kind of person where I just want to know for the next 5 years exactly what my mortgage payment is going to be. It's not going to change. It's not going to go up. It's not going to go down. The reality is I can budget for this for the next 5 years.
Hmm.
Then there's some real value in understanding that. And then at times, like we have recently seen, where rates went up crazy prospectively,
Hmm.
some people were very grateful that they were locked in for the 5 year. And so the fixed rate, I guess the way that I think about it is basically what they're saying is that's a rate that doesn't change for the period of your term, be it 3, 5 years, whatever you do. What's the maximum fixed rate term that we see right now?
So, I mean, generally you don't really go, but we don't see much above 5 years right now because generally the interest rates above 5 years are too high to even consider. But they go anywhere up to 10 years. So, back in the day, 10-year mortgage was very common because they had decent rates. But right now, to get a 10-year term with how volatile the market is and the interest rates are, it's unheard of. You don't really see it much right now.
Yeah, it doesn't make sense. Just understand and be aware that if you are a creature of habit and really like everything structured and want to know what your payments are for the next decade, something like that is available. But the reality is the bulk of the market is going to be looking at 3 or 5 year rates. That just guarantees what your payment will be for that next 3 or 5 years. And
Mhm.
then you were moving to variable.
Yeah, so if we flip to variable, and like you said, it's a big thing to look at what the rates are and what options you have for fixed versus variable. But a big thing with clients is what do they feel comfortable with. So just like you said, if they want their payment fixed, then fixed is kind of the way that they should go. But variable does have a little bit more flexibility. So our variable interest rates, it'll move with the market. So your interest rate is tied to our what we call the prime rate. And as the Bank of Canada makes these announcements to their policy or overnight rate, you will see that the variable rates will fluctuate along with that. Unlike the fixed that will move with the bond market and the economy, those types of things, the variable rate will move with the prime rate. And when you do see those Bank of Canada announcements, that's what's going to be affected, those variable rates. So those ones will change. There's different types of variable rates, and they do have terms linked to them. So a lot of people, the misconception is variable rates aren't in a term, but the common one is a 5-year, so you're with that lender. So at the end of that term, you can switch. So there are some penalties with variable rates, but for the most part, you can lock into a fixed rate. Your payments will change, your interest rate will change, so you're not as locked in as you are with a fixed rate.
Yeah, and so something that you touched on there, and I get the question often asked. We hear Bank of Canada is dropping their rate somewhat rapidly, or they have, and they intend to for a little bit. How is that going to affect rates? And I think you touched on there, it's going to affect the variable rate mortgages. It won't affect the fixed rate mortgages. So if you were wanting to buy a home today, but you did want to participate in some of those rate decreases, it might be worth doing the evaluation to see if a fixed rate is still going to work for you, and you could take advantage of the rate dropping. But fixed rates aren't necessarily cheaper, variable rates aren't necessarily cheaper than fixed rates, are they?
No. So yeah, that's a good point to make, is variable rates actually sit a lot higher, about 1% higher than what a fixed rate is at, only because of, they're tied to the prime rate, which is higher than, the bond market, stuff like that. So let's say, for example, a 5-year fix that we can get right now is around, 4.4, 4.39, 4.4. Whereas a 5-year variable is sitting at around 5.5. So, we saw the Bank of Canada make an announcement earlier this month, September 4th, and they decreased their policy or overnight rate by 0.25%. So the policy rate is something that the government uses to help control inflation. And so their policy rate is sitting at 4.25% now after their recent rate cut. And our prime rate sits about 2.2% higher than their prime rate. So our prime rate is sitting at about 6.45%. And then with that prime rate, that's the one that will fluctuate and change your variable rate. With that prime rate, most lenders will give around a 1%, usually 0.95% discount on the prime rate for what the variable rate will be. So if you look at our prime rate at 6.45, the discount of 0.95%, most of our variable rates you can access right now are at about 5.5%. For that 5 years. So looking at 5.5% for a variable that, may continue to come down over the next year versus our fixed rates at about 4.4%, there is quite a gap there as well.
Yeah, no, and that's powerful to understand. And also, everybody, I want you to understand today's September 23rd. I love the fact that Adrea is talking about what the rates are today, because it really gives us a perspective, but understand that they can change next week. And so these are the rates currently as of September 23rd. If you want information about the rates today when you're watching the video, just reach out to Adrea and she'll be able to answer all that. All Andrea's contacts will be in the description below. Now, Adrea, we also assume as soon as we see the rates that everybody's going to get the rates, and it's not dependent on many things, but we also don't assume that it's dependent on down payment. So how does the down payment affect rates?
Yeah, so the down payment will affect what type of mortgage you'll carry. So the typical 5% down payment will give you what we call an insured mortgage, because when you put down less than 20% on a mortgage, you will have to pay what we call a default insurance through CMHC or SAGEN or Canada Guarantee, and that is what protects a lender in case of default. So they require borrowers who put less than 20% down to pay a 4% premium on a default insurance that will be added to your mortgage to kind of cover them in case of any kind of default. So in that case, lenders will give you what we call best rates. So when we're talking about lenders, if you are putting down less than 20%, but adding on the amount you need to pay for a default insurance, you will get access to what we call those best rates. Now, looking, if you do put over 20% down, your mortgage is now called, it's what we call a conventional mortgage, and insurable at that. So at that point, when you're putting down, let's say 20%, and your loan to value is now 80%, so you're taking out a mortgage that's 80% of what the value of your home is, you're not going to quite get those best rates anymore. And that is only because lenders will now have to pay on the back end for, insurance on that mortgage on their own dime. So because you're not paying for the CMHC default insurance anymore, now they take on a little bit more of that risk and may purchase insurance on the back end. And so now they'll put a premium on your interest rate, and you are going to pay a little bit higher interest rates. When we get down to, like I said, those loan to value amounts, once we hit, less than 65% loan to value, so you're taking out a mortgage that's, 65% or less than what the value of your home is, that's where a lot of our monoline lenders, those lenders that only deal with mortgages, will now give you access to those best rates again. So the amount of down payment you have, people may think it just affects what your mortgage amount will be and what your payments may be, but it actually does affect what interest rates you have access to.
Yeah, if you have an insured mortgage and you've gone through the process, they've verified that all the information's accurate. Basically, corporations like CMHC or Genworth are guaranteeing to the bank that if you don't pay them, that the corporation will pay them, the insurer. And so there is less risk to the lender. And so the way I like to explain it is when there's less risk, then you can provide a little bit better of a value. And so, no, that's perfect. Now, something that we are seeing, there's a lot of, I say terms being thrown out there, but words basically, and we hear term and we hear amortization, and some people confuse them. So can you just briefly explain the difference between the two? What is a term and what does amortization mean?
Yeah, so when I touched on fixed rates earlier, and I said, that rate is the same through the whole term of your mortgage. The term is what we call the length of time you commit to that mortgage with the lender at a specific interest rate. So you're almost in a contract with that lender at that rate, and tied to any conditions you have to that mortgage for the length, the term length. So whether you chose, a 3-year term or a 5-year term, or like say we talked about 10-year term, if you sign a commitment with a lender for 5 years, you are obligated to those payments, to those conditions on that mortgage for that length of time. Now, when we flip and we talk about the amortization, that is different than your term. So the amortization is the life of your mortgage. Or, so to say, if we were to fix in that interest rate, those payments, that kind of thing, for 25 years, that's how long it would take to pay off your mortgage. So the amortization is kind of the whole life of your mortgage. Your term is, the chunks that you're going to pay at specific interest rates with specific lenders. But at the end of every term, you can change your interest rate or change what lender your mortgage is with, where your amortization is kind of just how long you have left to pay off your mortgage. So it's good to know the difference between what a term is and the amortization of your mortgage.
Yeah, I agree. I like to think of the amortization is basically how long is it going to take to pay off the mortgage? Mm-hmm. And the term is the contract with the lender that the two of you are committing to each other. Yes. So the length of time that they're committing that rate to you and the length of time that you commit to have your mortgage with them. Mm-hmm. Okay. So pretty important. So now, how important is it for a lender or a borrower to work with a mortgage broker versus going directly to the bank?
Yeah, so looking at the difference between, what can you get out of a mortgage broker versus just going to your everyday bank. And the key difference is that a mortgage broker, such as myself, we have access to so many different lenders. So not only just those big 5 banks, we have access to, monoline lenders or B lenders, private lenders. We have so many different choices and options that we can look at. Different rates, different mortgage options, such like if you want to put on a home equity line of credit, or looking at different things that you can do with your mortgage. Whereas a bank only holds what kind of interest rates and options that they have within their bank. So, a mortgage broker gives you a lot more options than just going to the bank. The main comparison I like to make is most people nowadays know or have worked with what we call the insurance brokers. So insurance brokers are very similar to mortgage brokers, where they kind of shop around and look at what kind of products and rates they have for your insurance needs, such as your car, your home insurance. Whereas mortgage brokers, we shop around and we can look at different options for your mortgage needs. So we can look at different interest rates and, those types of things, different lenders you can choose from. So, it is important to talk to a mortgage broker and just find out what you have available to you, so you're not just limited to what your bank may hold.
Yeah, I also think there's power in understanding this is a contract with the bank. So there are multiple different terms that are in the contract. Mm-hmm. And so sometimes the terms are even more powerful than the rate itself. So a simple example is they like to refer to it as a prepayment privilege, saying, hey, you have a privilege to be able to pay part of your mortgage down.
Yeah.
They all are structured a little differently. Sometimes they say you can do it monthly. Sometimes they say you can do it annually. Sometimes they will limit the amount that can be paid either monthly or annually. And so if you were the kind of person that received a bonus every year and you said, I'd love to pay down my bonus, that may be an important discussion to have. And so it's not just about rate, it's about the terms that are structured into that contract. And every lender, I say, has a different personality. There's certain characteristics that they like in a homeowner, a borrower. And so what they do is they structure their offerings to suit those individuals. So you may go into one branch and they say, yeah, we can't do anything for you. But you go see Andrea and Andrea says, sure, we got these 5 options depending on the lender and the terms that you want. So there's some real value in being able to go back and forth for Andrea to be able to go back and forth with a few different lenders to be able to truly understand where the value is for you. And now we had also teased a little that the Bank of Canada, or not the Bank of Canada, the federal government has announced that they are considering some changes. So Andrea, can you speak to that briefly?
Yeah, so we just saw, I'm sure everyone's kind of seen in the news, that the Liberal government has announced and proposed changes to the Canadian mortgage market. So they're potentially looking at expanding on their 30-year amortization and raising the cap for insured mortgages from 1 million to 1.5 million. So what that means is, right now, people can buy up to $1 million with less than 20% down. So getting that insured mortgage. So how we talked about, if you only put 5% down, you're paying, that CMHC default insurance to get those best rates. But we were capped at $1 million. So you could only put 5% down up to 1 million. And now they're looking at increasing it to 1.5 million for insured mortgage. So that'll kind of open up the market to, more borrowers would have access to those higher mortgages. And I think you could probably touch on this a little bit more on markets such as Toronto and Vancouver that have higher house prices, that, this may open up for certain people.
Yeah, and so the 30-year amortization, I think, is stellar for a number of different reasons. It will make qualifying easier. It will give people more options. It may help them get into a home versus a condo, that sort of thing, if that is important to them. So I'm a big believer in options. So long as we're coming in from an educated decision point of view, then it strengthens our position as a homeowner. The increasing from $1 million to $1.5 million, I read an article recently that talked about, to qualify for the $1.5 million, you need a $250,000 family income. And so we are just talking about that very top elite section of income earners. And so I struggle a little when they talk about it benefiting the average homeowner, because the average homeowner, even in Toronto, I think I had read that it was under $700,000 is the average first-time homebuyer in Toronto, and under $800,000 is the average first-time homebuyer in Vancouver. So they aren't even reaching those $1 million marks as an average, right? There will be some that are up there and capping, but the average individual is not even heading anywhere near that. And so I do have some questions with motive. I have some questions with who it is going to benefit, and we'll only have to wait and see. But this is something really that is only being offered to the individuals that have a family income of over $250,000, and so um, I don't quite believe that it is to help the first-time homebuyer. I think my biased, uneducated opinion would be it's more to protect those individuals that had bought a home and now they're up over a million, and we're starting to see the values start to decrease.
Mhm.
So it may help push some of those buyers into that over $1 million price range, which then would allow them to keep that market stronger. The more buyers that are buying in that market, the stronger it would be. But also, are there really that many buyers in that market? So I haven't heard any stats of how that would change.
Yeah.
But once again, I'm skeptical on that.
Yeah, so like the talks that I've heard, and since this announcement has been brought up, I mean, it's sparking a lot of controversy. Exactly what you were saying, like who are we really helping, and how far is this going to go? I mean, there's a lot of talks too, is that people get into these 30-year mortgages on such high mortgage amounts, and then in the long run, is it really helping borrowers, or is it putting people a little bit behind? But I do want to make sure that everyone is aware that this right now is all up in the air. It's awaiting approval. And if it does come into play, it won't come into effect until December 11th. So, this is all just in the works right now, nothing set in stone. But, it's great for them to come out with this so that we can all have these conversations and, see where it kind of lands, like how, whether this is really going to help, or like you said, what motives are really behind this proposed announcement. So
Yeah, and I think the 30-year amortization is great because it's giving options. I do have some issues that it's only for first-time home buyers. Okay, in all the programs that they keep announcing, right? They're really gearing towards that first-time home buyer, and in some of the programs, they've said first-time home buyers under 40 years, I think, 40 years old. And so, some of
this
these
new
programs are really
announcement is
geared
actually
towards.
for
Sorry, go ahead.
everybody. I don't think that this new announcement is for everybody. It's not just for first time.
Yeah, and so I was speaking to basically the last announcement, where
Yes.
start to look at, why are we only gearing towards those individuals? Because there are individuals that maybe had been lifetime renters, and all of a sudden they're back in the good job, or maybe they've remarried, they had a divorce, they weren't able to afford a home. Now they've remarried, they have two incomes in the house, and now they would go to buy and they wouldn't qualify. So it's nice to see that, or it'd be nice to see if the government started opening up all programs for all individuals to be able to qualify, because as we start to really have them gearing towards specific demographics, then you start to wonder, is this a ploy to buy votes? What are we trying to achieve here? And so,
Yeah.
I'll
I
just
think
leave it
this
at that.
announcement too, they're probably putting out the feelers to see kind of the response to this one, to see kind of where they go from here. And
Yeah, that's exactly it, right? It's almost like leaking some information. What's going to be the response, and how do we react? So, no, eager to see that. When we start to look at rates, there's always the question. So there's hesitancy that gets created. So people are saying, hold it, should I hold off and getting a mortgage or buying a house now or making my changes? The reality is we have to live indoors. And so what I would do is chat with Andrea, chat with myself, and we can do some evaluations for you. Because when you start looking at the cost of rent, the way it's increasing, and home values in Alberta, the way that they're increasing, sometimes you're trying to wait for a rate decrease. And really what you're doing is you're trying to save $10,000 over the next 5 years in a rate decrease. But really it's going to cost us $20,000 in appreciation. And so, there's that old saying, what you bite off your nose to spite your face. When we start talking about interest rates and we start speculating, then it can really actually affect us negatively, quite dramatically. And so my suggestion, reach out to Andrea. We can chat about the rates. Reach out to me. We can chat about the market and the segment that you're in. Certain segments are much hotter than other segments. And so it wouldn't surprise me if a cost of waiting in some situations could be $30,000 or more, and really you're only going to save $5,000 over the life of a mortgage or over your term, your 5-year term. And so reach out to us, ask a bunch of questions. We're always open. I'm just going to check online to make sure. Yeah, no questions online. So thanks for joining us, everybody. Appreciate this. And Mortgage Monday happening every Monday. We're a little early today, but we generally try and shoot for around noon. And if you have any questions that you want us to address, either comment below or reach out to either of us, and we'd be happy to address it in a future session. Thanks, Andrea, for coming in.
Thanks, Jason. See you next Monday.
Bye-bye.